Good morning, everyone. If you're in the Northeast, maybe across the country, getting absolutely blasted with snow right now. Unicus, good morning. Can you hear me, Lex?
Yes, George, good morning. I can hear you.
Excellent, excellent. So I don't know why I picked that song. Originally, I was trying to find a song something to do with copper and heavy metal, and that didn't work. So I said, "How about power?" And I found this song. Whatever. Anyway, that we all remember that tune. That's from 1990. The Power, sung by a song by the German Eurodance group Snap, featuring American rapper Turbo B. And I see John Roque is in the house, so maybe he can explain to us who Turbo B was, and also American singer Penny Ford. Any event. So enough of that. So here we are, Sunday morning. I think we're settling into this cadence. We're going to do these spaces every Sunday morning at 11. It seems to work well for a lot of people. A lot to talk about as usual. A lot of moving parts in the market. It's always a challenge what to put out for a title for these spaces. And I was triggered as I usually am. You see, I put in Dunning Kruger effect year to date, bro, momentum, bro. And really, what I'm getting at, I know we're all exposed to the same thing, but the market's been pretty snappy to start the year, and the number of folks who are chirping about their performance. I'm up 15%. I'm up 20%. I'm up 25%. Someone's complaining they're only up 10%. I mean, this is not normal. And there's also a tendency to always focus on year to date numbers. But so year to date, bro, the people chirping about their year to date performance. I mean, it doesn't prove anything, but it it's interesting. I suspect this isn't going to last, but who knows? And then momentum, bro. Again, folks who they have no clue what they're buying. It's just number go up, and I find those to be the particularly obnoxious types. Funny story about that, actually. I started to write regularly on my Substack, and it's been a while since I've been writing regularly. It was interesting. I put out a report this past week. It was the first individual stock recommendation. Again, do your own research. But I wrote a short blurb, a couple pages. It's on my Substack. I'll shill shamelessly for my Substack. Go look at the Substack. It's free. It won't be free forever, but it's free. Anyway, I put out a report on Southwest Airlines, ticker symbol LOVE, LUV. I heard the stock pitched a couple of months ago at a conference. Elevator pitch sounded pretty good. And then I saw the other week Jamie Baker, the probably the dean of America of airline analysts on the street, been at J.P. Morgan forever. He issued a double upgrade on the stock. He went from a sell to a buy, which is kind of unusual. And I think previously he had a price target of 36, and he slapped a $60 number on it. So I'm like, okay, if he's turning, and yeah, the chart looks good. I mean, John, let me get John in here. So John, once you get in here, one of the the first things I ask about is a ticker is a chart of the airlines in general, and Love Southwest in particular. But anyway, so I'm writing this note on Love, and I put in the bullet points, and I tried to model after what I'd have to write for Peter Lynch at Fidelity. We used to have what were known as investment committee reports. It's pretty straightforward. You state the particulars of the company, the elevator pitch, positives and negatives, strengths and weaknesses, catalysts, some verbiage about what's going on with the financial condition of the company, the balance sheet, the income statement, the whole thing, what could go wrong, et cetera, et cetera. And so I write this thing, and I had a friend of mine edit it, and it was funny. I looked at he threw something to ChatGPT to see what would come up, and what was wild was I looked at the reports other people were putting out, and here I am. Yeah, I'm old school, so I'm talking about valuation and fundamentals and very rational left brain discourse. Everyone else is just talking about the momentum and the narrative, the momentum and the narrative. And on that basis, Southwest Airlines could be at 60, could be at 6, could be at 600, could be at 6,000. Momentum's not a thing. Sorry, prices, the evaluation's not a thing. And I had a similar dust up yesterday with somebody. I wrote this. Oh, we got to talk. We'll get to the tweet later. The tweet I had that had over 3 million 3 million views is just crazy. Elon Musk weighed in on. But in any event, I wrote this thing about. It was a tweet. You can go look at my feed. It kind of broke the internet the other day, and it was going on about OpenAI and, as he's affectionately known, Scam Altman. So somebody, guys from Coastal Ventures, whatever, one of these Silicon Valley guys. I'm sure he's a smart guy, but he's telling me what I don't understand, this, that, and everything else. But I was a bit offended by his tone. It's like, what I don't understand. No, 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 no. We may disagree, but don't tell me I don't understand. How would you like if I told you you don't understand? People just have no manners. In any event, so I said, excuse me. I said, everything you say might be true, but your report's a major fail for me because there's nothing in there at all about the valuation of the company. And he's going on, well, valuation, it's just a static measure at a point in time. It doesn't mean anything. You're being short sighted, not thinking about the long term. Okay, fine, fine. But when I ask him to talk about valuation, he dances around the subject because obviously indefensible. So then I pointed out to him, I said, look, look, none of us really know, but let's just try to define the rules of engagement, have a reasonable discussion about this. I think any sane person would agree there's got to be some attention paid to valuation. It may not be the most important thing, but if you're going to recommend OpenAI or Southwest Airlines or whatever it is, everything he says can be true. But whether OpenAI is worth 500 billion, 50 billion, 5 billion, 50 trillion. I mean, there's nothing in that he was saying in his line of reasoning that would guide you, that would inform you as whether you should invest in it. So the debate isn't whether or not OpenAI is going to be successful. Well, who knows? I mean, I don't think it will be. Let's assume it is. Let's assume it is. How do we know if 500 billion is the right price? Well, I'll get to Unicus in a second. Let me just go on my rant here. Well, I don't know. How do we know 500 billion is the right number? Maybe it's 5 billion. Maybe it's zero. Or maybe he's totally wrong. It's not 500 billion. It's 500 trillion. So anyway, this is a major. The reason I'm going really banging away on this point, this is endemic to so many players in the market now. They ignore valuation for a variety of reasons. You know, whether it's the fact the market's been going up all the time and who cares, if you looked at valuation, it just stopped you from investing in this speculative thing, which is successful, or that speculative thing. Or as I fear is many times the case, they don't know how to do valuation. They don't know how to do fundamental analysis. And I go back to the Southwest Airlines report. Go look at my Substack. Sign up for my Substack, please. All right. All right. GeorgeNoble.substack.com. You look at the thing, it's not rocket science. It's a basic two-pager. It's a sort of thing that, if I was working at Fidelity and I had to go pitch a stock to Peter Lynch in the research department, that's kind of the thing I would do. And if you want to know more, and John, when you get in here, I want you to talk about, I can't remember, I told a story the other day about someone, about the general that you once met, about how much information do you know to need to make a decision. You know, to write a 50-page report, I guess the vernacular these days was a TLDR, okay? Nobody's going to read it. Most 99% of stuff that they put in is irrelevant. Okay, nobody really cares in investing and trying to figure out whether Southwest Airlines is a buy or a sell. And it could be a sell for all I know. Whatever. Okay, the point is, do you really care what year it was founded and where the founder of the company grew up and how they merged with this other company 20 years ago? It's all irrelevant. So as John always says, and John, you got to tell the story. How much information do I need to have in order to make a decision? So I wrote this report. And it was hilarious because I was comparing this report to everything else I see out there, and it's like it's almost like I'm a crazy old man. It's like, what are you talking about valuation? What are you talking about the fundamentals? No, it's just what's the narrative and what's the chart. But that's the world we live in. That's the market we have. And what's the saying? You got to trade the market you have, not the one you want. So I don't know. Dunning Kruger effect. You're all familiar with it. People have a false sense of ability based on early success. ultimately leads to failure. Problem I have with this market, I just think it's broken in so many ways. And I'll stop in a minute. And I want to go to, and because if you don't mind, I want to get John Roque in here first because I don't know how much time John has, and then we'll go to you, Unicus. Um, you know, people are just the market's broken. The last thing I'll say, I was talking to a reporter the other day. As a matter of fact, you can go look on Business Insider. It's behind a paywall, but the article came out this morning. I got a call from this nice fellow, Samuel O'Brien. He wrote a report. He wrote a story on Tesla. It's I'll put it up on the nest. It came out this morning. It's it's a negative piece on Tesla. I spent a lot of time with them, guiding them through the report. And I was reminded, talking about what could go right, what could go wrong with the thesis. And by the way, we got to get into the scam that Musk perpetrated this past week with the bogus self-driving cars. This is like analogous to Nikolai with pushing the truck down the hill. It's the same deal. In any event, um, he's like, "What could go wrong?" I said, "Well, I'm reminded of a story Jim Chanos likes to tell. I can't remember what the name of the stock. It's not important, but this is like 20 years ago. He's pitching some bear case on a stock, and he was asked what could go wrong with the idea. To which he responded, "Well, maybe just nobody's going to care about the fundamentals. Nobody's going to care about the numbers." And that's the way I feel about a lot of this stuff. We'll go anyway. Enough. You get the point. So, with that, I got plenty more to talk about, but not to worry. Last thing before we go any further, aside from the Substack, the commercial message for the conference we're having March 11. The website is up. You guys have no excuse for not coming to this conference. It's $99. $99. You can't go out to dinner for $99. Can you imagine what it would cost to go to a conference? It's any schlocky conference, all right? $99, and we have a lineup of speakers which is better than any conference you'll ever find. Unlike a lot of these conferences where you have bloviating macro nonsense, and you sit there and it's like, oh, okay, well, that's a few hours of my life I'm never going to get back. What do I do with that? Well, I think the GDP was this, and the yield curve, and the SOFR rate, and the Fed funds, and the dollar, and the Fed, and it's going to be Rick Reeder or Kevin Warsh. Like, who cares? We're trying to make money. We have an outstanding lineup of speakers. There are 14 speakers in total. It's March 11. It's online. If you can't listen to it live, the replays will be available within 24 to 48 hours. We did this. We had two conferences last year. We had one more of a macro strategy conference. John Roque was brilliant. Okay, and then we also had a stock picking one, which was in end of July, and we're trying to follow on the footsteps of that great conference. We have Renaud Soler, who killed it with a nuclear recommendation. Tom Chanos, Jim's brother, was short. Fresh Pets is a great idea. I'll quickly go through the rest of the names. Tom Thornton actually nailed DoorDash on the short side pretty well. So it's both longs and shorts. Adam Parker had a great long ATMU. Gordon Johnson, no stranger to these parts. Robert Mullen, his fund, by the way, MRA Advisors, just so you know. I mean, he's not a household name, but that's the cool thing about this conference, as opposed to the usual folks who are on every day. Robert Mullen, MRA Advisors, maybe he'll come in the room this morning. I don't know. He's probably sleeping. He's out in San Fran. His fund was up over 100% last year. He's been killing it in natural resources. Zach Marks had a great healthcare name. I can't remember what it was. One of these four-letter words. Great investor who you've probably never heard of. Enrique Abeta. Um, idea hasn't worked quite yet. Nvidia is a short. Alberto Alvarez. Oh my god. Oh my god. Alberto was pitching. I think the Platinum ETF is a long. He also had Sprott as a long. The Platinum ETF, I think it's tripled and Sprott's up. I don't know, 60%. Motorhead. Tavi Costa. You want to talk gold and silver? Tavi Costa's your man. Van Drunkenmiller, who has not been seen a lot of late, but he's going to make a special appearance. Don Durrett, you want another gold heavyweight, proprietor of goldstockdata.com. Fantastic. And then Jack Gamble, also known as Nobody Special Finance on YouTube. Jack spoke extensively in our space last week. He's got the receipts on the AI trade, nuclear, and all the other nonsense going out there. So action packed 14. You're going to come away. Each guy's going to have one or two names. She'll come up with 15, 20 ideas, $99. So if you don't come to this conference, and I'm ashamed, I feel like I have to have a co-host who can show for me. If you're not willing to pay the $99 for this conference, then you have no business running money. You don't know what you're doing. To me, not paying $99 means you don't understand what value is. You want to go listen to some bullshit thing where they have a keynote address. Well, John, I'm going to come to you in 1 second. Well, we have John Roque with us here today, and John is going to talk about what it was like growing up in the Bronx. And John, what was your biggest disappointment as a young man? Well, it's when the Yankees lost the World Series and blah blah blah. John, what lessons would you give? People don't want to hear that shit. They just want to make money. No, no, no disrespect, John. So anyway, we're trying to help people make money. That's what this space is about. That's what this conference is about. And I made it only $99 because the conference last time, the quality, the content was grade A. But frankly, I wanted to make this open to a wide array of people. I thought $400 was a great price. Apparently, it wasn't. So I hate this overused word. We're going to make it more inclusive. The democratization of finance. Whoever thought I would have been for the democratization of finance? All right, enough of that. Without further ado, and so John, I apologize. I understand you could not get into the space last week. That's because Mr. Musk can't run this damn app. The space blew up before it ever got started. I guess you would call it a never was. Not a never was. I mean, I think it lasted like 30 seconds. So anyway, John, good to see you. You're not far from me as usual, so you got a lot of snow on the ground yet, John?
Yeah, George, but I got to say, I'm a Mount Vernon guy, not a Bronx guy.
Mount Vernon guy. I forgot. All right. And by the way, I still got to go to those places on Arthur Avenue you told me to go about. So, John, a lot of moving parts, markets all over the place. I don't rather than BSing about the market. It's always a market of stocks. And came into the year, I was expecting, like you were expecting, a lot of rotation. You were banging the drum pretty heavily on the Russell. And by the way, he won't say it because he's too modest. But there are a lot of Johnny come latelys who's jumped on the bus. Oh yeah, I'm bullish gold, bullish copper, blah 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 blah. Blah. But I have the receipts, Mister Roque. It's embarrassing. This is like a Ruthian type of shot. Talk about going yard. Mr. Roque has nailed this gold and silver trade like nobody else I know, and so he has license to weigh in. I don't care about some dude with his baseball cap on backwards who, the GLD discovered GLD and thinks it's a meme stock. Can't tell you what it does, but the chart is up and to the right, so he's bullish. And okay, so but we don't we so those people don't have standing with me. Mr. Roque's bona fides need no introduction. And John, my hat's off to you. He's totally nailed this one. So congrats, my friend.
Thanks, George. Very kind of you. Thank you very much.
All right, so John, as you know, unfortunately, you're only as good as your last trade. So I guess one of the questions you can talk about whatever you want, but let's just start off this way. So one of the questions I think that's, and I'm going to frame it in a sort of provocative way as I'm want to do because it's boring if you want difficult questions, so I'll tee it up for you. So gold and silver, people are chirping. I'm going to take the contrarian view though here. I'm going to argue that not you, but they are not bullish enough, and the reason I say that is everyone's saying, when do I sell my gold? When do I sell my silver? When do I sell? When do I sell? Okay, now you have to juxtapose that with a lot of people jumping on the bandwagon. I get that. But I don't see, I see a lot of people, questioning when they should sell or saying it's overbought. And as we all know, John from Frank Tech Share, when people say something's overbought, it usually means, the real definition of overbought is I forgot to buy it and it went up anyway. Just like, oversold is I forgot to sell it and it went down anyway. All right. So I see a lot of people claiming it's overbought. Now we have the Rokian rule too. So this is complicated. It's John, my cat doesn't go so high. I mean, normally I know 100% over the 200-day you're like, or 150-day you're out, but this is like we broke the meter. So something's going on here. So I don't think it's so simple to declare it's a sell one normally would. But let me put it to you this way. Here's a thought experiment. Imagine you had a company that was going bust. And their bonds are plummeting, and their CDS credit default swaps are going to the moon. If it's going bust, and you're convinced it's going bust, and the CDS is skyrocketing as a result, or your put options are skyrocketing as a result. If it's going bust, I don't think you're going to be asking yourself, "Oh, when do I sell my CDS?" If it's going bust, you're going to get paid if you've done your work. And in my view, when people say, "When are gold and silver when are you going to get out of the trade?" Haven't been as long as you have, John, but long enough. Well, you tell me when the dollar, when the value of fiat currency is going to start going up, and then I'll tell you when you should get out of when gold and silver are going to go down. You tell me when we're going to have responsible fiscal and monetary policy take over, and I'll tell you when gold and silver are going to start going down. You tell me when the global geopolitical situation is going to settle down, and I'll tell you when gold and silver will start going down. You get the picture. So it's all along. Is there a question here? I'm sure you're probably wondering. Yeah, there is a question. John, what the hell are we supposed to do with gold and silver right now?
George, I think that if you already own gold and silver, I think that accepting for the fact that silver is 120% above its 200-day moving average, these are, tremendously bullish bullish situations. Not only have they advanced on an absolute basis, but in October of 2024, gold made a new all-time inflation adjusted high. It finally got above what was its former inflation adjusted high, which occurred at its prior peak, going back to January 1980. Gold is up 82% just since October of 2024. It was 27.44 then. It's almost $5,000 now. And when it made a new all-time inflation adjusted high, I thought that you and I and everybody else could not have enough gold on their books. And so far, that's been lucky. Now, silver, by contrast, has only recently gotten above its April 2011 inflation adjusted high. It is still about 40% below the January 80 all-time inflation adjusted silver high price. So gold's above that former high price. I think silver will get above its own January 1980 inflation adjusted high price. I would just love to see silver itself consolidate a little bit. The most recent consolidation, laughingly, happened from December 26th through January 9th. And since that time, silver's up another 25%. So I'd love to see there some consolidation. It would not surprise me if there's a pullback. But I think on any pullback or any consolidation, I think we need to, consider if you haven't added some. I think on any consolidation, it's probably right to do some buying.
So, John, just generically, because you're the master of charts and patterns. So help us in the room. But I've been around long enough to know when a market trades like this, when it trades bid, and it just comes back. It sells off, comes back, sells off, comes back. That tells you a lot. And this market trades like it's not going to let you in, and it doesn't let you in.
Yeah, well,
And
the good
so,
ones never do, right? And the
correct.
bad ones never let you out.
Correct. And interestingly, because we're all sort of, I don't know, old hands at this, and maybe we didn't share in the buoyant enthusiasm of the Bitcoin crowd, the crypto crowd. Okay, they got no problem with this. If they'll care to the win, like, go for it, man. All good, right? But think about it. If silver, here's a thought experiment, John. Imagine this. I know you have a snappy comeback for this one. Imagine if gold or silver was a crypto stock or Bitcoin. There's nothing unusual about this bait. We wouldn't be it'd be like, wait a second, bro. These things are supposed to go, they're supposed to moon, bro. Like, this is nothing. Like, gold compared to, what Fartcoin did or Solana or whatever, like, John, 80% in 14 months, like, this doesn't begin to register as anything terribly special. But the problem is, you know, we know the crypto crowd, that looks like in another world. But when these guys get a hold of this stuff, it's just they push things. And John, I know you have a great line about reversion to the mean, beyond the mean. But in a totally different context, I was speaking with somebody the other day about their strategy in investing, and I asked him. I said, "Well, what occurs to you?" He goes, "It wasn't just about gold, just in general." He goes,
There's no mean reversion in anything. I mean, okay, it's like things go up, they go up far more than you ever thought they could. And likewise, he was saying when things go down, the same thing. And so, we could talk about micron technology later, which I think we talked about it last week. We'll talk about it again. But, given that seemingly they've tried to outlaw the business cycle, nobody cares about evaluation. I mean, this is like not the market you and I were brought up with, but just when you thought something's gone far enough, it just keeps on going. Any thoughts on that, John?
Well, I think in many respects, and the gentleman you referenced is right. I thought the same thing this environment, which I think is dominated not by, let's say, and this is not disparaging, the Fidelities or Wellingtons of the world, but I think it's dominated by pod shops, algo, passive trading, and I think retail has a very, very big effect on the markets. And I think you tend to get tremendous overshoots to the upside and the downside. And let's just take silver for example. And silver has been mercurial, has been agita inducing, and it has been gray hair producing. But it doesn't change the fact that since the late 60s, silver is always a base and breakout item. Always.
John, you still there? Hello? Hey,
It
Unicus.
should.
Hey,
Yeah,
John,
yeah.
yeah, we lost you for
Sorry.
10. Just John, just rewind 10 seconds, please. Go ahead.
Okay, so silver has always been mercurial, agita inducing, and gray hair producing, but it doesn't change the fact that the metal has always been a base and breakout item. And the chart itself on a quarterly basis should be in a base and breakout textbook. There have been umpteen bases for silver going back to the early 70s, mid 70s, and each time you get paid owning silver. This time you've gotten paid spectacularly in such that the metal is now at a new all-time high and has been at a new all-time high for the last 50%. Now just consider the following. This is not a forecast, but just consider the following. Old-time technical hands will likely say that this is familiar to them, and anybody who's a point and figure aficionado will likely say this is familiar to them as well. So if you take silver's average price since 2011, which is $25, and you multiply it by the length of the base since 2011, which is 14 years, $25 times 14 years gets you to a price of $350. Is that legitimate? I really don't know. But this is how perhaps we can come up with price targets such that we don't have any history to help us identify future price targets. I've used the same method to come up with a price target for Newmont Mining, which I don't want to say here because it will probably prove that I've probably looked at too many charts. But in order to come up with potential price targets, given the demand for commodities. And I believe, George, that the street has had the narrative incorrect. The street has had the following narrative: labor cedes its power to capital, and capital invests in AI. And I thought the street had it wrong. I think the equation is labor cedes power to capital, capital invests in commodities, and commodities are used to power AI. And I think the street through the end of 25 and certainly now in 26 has recognized that natural resources are important. And that's the reason we're seeing accelerations despite prior overbought readings. I think it is important also to state, unlike equity bull markets, which are based on hope, commodity bull markets are based on fear.
Wow. So hang on. So say that again.
I said, unlike equity bull markets, which are based on hope, commodity bull markets are based on fear. The fear is that you're going to have the commodities and I won't.
Wow.
And
That's well.
that's true for nation states as well, right?
Yep.
So I think I'm not forecasting any conflicts, of course. I'm just saying that commodity bull markets are based on fear. And I think that's the reason that we've seen what have been overbought markets or overbought items become egregiously overbought items. And please also consider silver, platinum, palladium. These are especially thin markets. They do not trade very well. So these markets, which don't trade very well, are often taken to great extremes because the order flow is light on both sides.
Well, John, let me interrupt you on that point. But I think about the way a lot of the younger investors like to play and the algos and the pie chops and whatever. Okay, those are the kinds of markets they love because it doesn't take much to push them. Whereas, God forbid, you want to buy, Microsoft or Exxon or whatever. I mean, these are the types of markets that these folks love to target. No,
Yeah, but I would almost suggest that the price action informs me that investors are not long enough.
agreed, agreed. In fact, John. I don't know if you looked at the chart. I think you did, but maybe update it. But the chart I've used a lot. And I appreciate there's been a proliferation of instruments, so you got to consider the whole picture. But that being said, John, if you go look at the shares outstanding, not the value, I know you know this, but just for the folks in the room, maybe speak to the shares outstanding and the value of the GDX, GDXJ, the relevant ETFs. I mean, it is staggering. Even in the GLD, like I haven't looked at it lately, but one of the things that just blew me away was how little accumulation there's been. And in some instances, the shares outstanding are actually lower now than they were 5 and 10 years ago.
Well, I think, I've used, let's say, the ETF flows in this regard, and the flows are not yet at former highs, which would again suggest to me that investors have not yet satiated their appetite for these items. And in addition, and I say the following, not to be pejorative, but just to be, I think correctly observational. I'm going to use you as my example. And we know each other a long time, so you know it's not an insult.
Yeah, go ahead.
George Noble is running at Fidelity a big cap vanilla equity fund. I come to see George in Boston at the offices right next to South Station. That beautiful office building. We go upstairs and George says, "John, what do you have for me?" And I say, "George, I really think you should own some metals." And you say, "John, I have exposure in metals. I own Freeport McMoran." I mean, that's pretty much the case when you're a vanilla equity manager. You own one stock because that's the representation via the weight in the index. You don't need to overweight these things based on your benchmark. So if you own a gold stock, I'm sure you probably own something like Newmont Mining. I don't think you own 5 gold stocks. And if you don't want to own the gold stocks because you might be branded a gold bull, which is like being a lower caste investor, then perhaps you own Freeport McMoran because that is easy to explain. But unless you're a natural resource investor or someone who doesn't have a benchmark, the likelihood that you own a swath of these stocks is pretty small.
So, John, to that end, I think it'd be helpful for everyone in the room because you're dealing. You could explain a little bit about, just elaborating on your point. Explain a little bit about what it's like talking to big institutions, and maybe more recently what those conversations have been like. Of course, we're going to keep everyone in the federal witness protection program, so you're not going to mention anyone by name. But the incentives for these folks, to them, it's more important whether they're, whether Apple 6% of the index, whether they're 5% or 7%, or Nvidia they're 4% or 6%, this, that, whatever. The way they're paid, the way they're measured, the way they're incentivized, getting those decisions correct, looking at benchmark risk, is far more important than whether or not they own, Freeport McMoran, which is, I don't know, a tenth of 1%, or Newmont Mining, where it's like, who cares, right? So, and then we'll get to the energy stocks in a minute, which are still, I think, only 3% of the index or whatever. So maybe I'd be curious, maybe explain to folks just a little bit more about what big money cares about, and particularly what's the sentiment you've been getting from people lately. Software stocks, for instance, right? Everyone's the beloved software stocks, which did so well for so long, and it looks like someone turned the lights out on them. And I think they look horrible in the charts, and the valuations still don't make any sense to me. So everyone's still staring around, looking at their own navels, worried about Nvidia and Apple and software stocks, when the leadership is in these other parts of the market. So just explain a little bit about the way institutional investors generically operate, and then what are they? What's a good representation of what they're thinking lately?
So I think it is more important for them to get their overweights or underweights correct rather than trying to buy Agnico Eagle mines. So, for example, I maintain a growth to non-growth ratio. I don't call it growth to value because, as a technical guy, I didn't want to have to define value. So, my growth to non-growth ratio. Anybody could do this. It's easy. In the numerator, it's the S&P discretionary sector plus the S&P technology sector. And in the denominator, it's the S&P energy, financials, basic materials, and industrial sector. So it's two sectors or ETFs in the numerator and four in sectors or ETFs in the denominator. And I just divide the numerator by the denominator. And if we take the most recent peak, which was on November 3rd for this ratio, that's where growth stopped outperforming non-growth. The ratio is down 13+% in favor of non-growth. That, I believe, is the raison d'etre for managers who have a benchmark, is to get this relationship right. And I'm not disparaging anybody because it's a hard job. And in fact, I spoke to somebody recently who said to me that rotating is an especially difficult thing to do. And I'm a little bit of a wise guy, not to anybody to their face, but I always ask. Rotation is kind of like the rotation word is the answer to everything with respect why the market's doing something. Oh, it's rotating. Oh, it's rotating. And so I always ask, where is the rotational champion at the end of the year to go on CNBC and talk about his or her bona fides with respect to how they rotated their way to winning the performance game? Where are they? Aren't they on the cover of Barron's or Forbes or Bloomberg Magazine? Isn't Tom keen to interview these people? What about Joe Kernan, Aaron Ross Sorkin? Shouldn't they get on the rotational champion? Where is he? Where is she? Do they exist? I don't think they exist because it's too hard to do. Because by the time we as humans identify that a rotation is underway, it's likely 6 weeks long or 4 weeks long. And then we have to say to ourselves, well, what if that's only the dip to buy? There was a similar rotation where growth underperformed non-growth during the tariff imbroglio. That was 18% from late December into the March low. 18% where growth underperformed. Don't you think that the growth people were glad they didn't trade out into non-growth at the March low and stuck with growth? Because from the March low up until the November high, growth was an outperformer by 35%.
Yeah.
So my reason for this diatribe is that I think the rotational game is very, very difficult. I think that people who claim to be doing it or winning it, I'm a little bit dubious because I don't know that I've met anybody over my entire career who says that they are the rotational champion. But I do believe that the charts tell you that something is occurring here.
Right.
By that, I mean that tech is no longer monolithic. Natural resources are ascendant. The Bloomberg Commodity Spot Index is in a bull market, so far led only by precious and industrial metals. There's been no bull market in energy. There's no bull market in ag. If there comes a point where these two sectors, energy and ag, kick in, then I don't think there will be enough natural resource related stocks to make everybody happy. In fact, George, and maybe you got this in your inbox, I sent out a note to clients, I don't know, maybe an hour or so ago. It was entitled Running with the Night. Now, if you'll remember, in Super Bowl 18 in 1984, Super Bowl 18 in 1984, it pitted the Washington Redskins against the Los Angeles Raiders. And while the score at the end of the game showed that the Raiders smoked the Redskins 38-9, the game was especially memorable for a play known as 17 Bob Trey O, and the highlight reel calling of that play by a guy known as the voice of God, John Facenda. Anyway, the line is that on came Marcus Allen running with the night. He had a then 74-yard record Super Bowl touchdown run. And my analogy here is that I'm sure you've noticed that precious and industrial metals are running with the night. And this continues to happen, I believe, because the street's narrative has been wrong. They've avoided commodities, and we see uh, investors who are underweight and need to get their weighting up. That's why these things continue to work as well as they do.
All right, John, you've been on fire. We could go all day. I have a couple more questions. If you can hang around, that's great. And we got Unicus coming in as well. This is awesome. Let me just throw a couple questions at you, and then I want to. If anyone else has a question for John, please raise your hand. And then I want to get to Unicus. So John, just briefly. So rounding that out, you correctly nailed the rotation to the small caps, the Russell, a few months back. Give us your mark to market on that. And energy, I know, to use your vernacular, has given you a lot of aja over the last couple of years. It looks uh, particularly promising to me. The stocks have done well. I saw a fantastic thing from our friends at Nautilus Research, which I'm going to put out today on my Substack, showing historically anytime energy has done this in this short a period of time, what it portends for the next 6 and 12 months, and it's unambiguously bullish. Also, the fact that stocks have been doing much better than the commodity. You talked about, fear versus complacency. There's also the idea that, commodities live in the present, the stocks live in the future. So I'm smelling a continuation of better times ahead for energy. I agree. If you go in hog wild right now, and this is not I want to keep this family oriented space, but one could be accused of, be guilty of premature speculation, perhaps. So, but I think it makes sense from a rotational standpoint, also gold following other commodities, the action in the gold, in the energy stocks, et cetera, et cetera. So I'm curious what you think about energy and any stocks. So, I guess putting that into a question, what do you think about the small caps? Again, what do you think about energy?
Okay, thank you. So I've gotten lucky with the small caps. I got lucky with them initially just on an absolute basis in the summer of 25. I thought that the Russell 2000 had a chance to get to what I thought at the time was a doable target of 3,200. So that's my target for the Russell 2000, 3,200. And at first, I thought this was just going to be a an absolute idea because, as Milton Friedman told us many years ago, that inflation is always and everywhere a monetary phenomenon. The Russell 2000 is always and everywhere an IWM phenomenon. By that I mean, no manager is going to sell 5% of Google and go out and buy 200 small cap stocks. It's not going to be done. But the IWM allows an easy way for people to get exposure to small cap stocks. And in addition, the E-mini futures for that particular instrument are well used as hedging operation for hedge funds or pod shops, etc. And the figures for that into the low for the Russell 2000, the figures were especially short into the autumn of 2025. I thought that a covering of the E-mini futures position for the Russell 2000 would be jet fuel for the advance. And so far, that's been pretty lucky. So the Russell's broken out of a base that goes back to 2021, and my target is 3,200. If you look at all Russell 2000 bull markets going back to 1980, the smallest prior bull market for the Russell 2000 has been 75%. It lasted 24 months and went from October 87 through October of 1989. The Russell 2000 has now had two consecutive bull markets. The first one was 51%. It stayed in its range. It didn't break out in November 24. And now it's up 55% and it's broken out of its range. So the next kind of hurdle would be the 75% bull market from October 87 through October 89. Otherwise, if you go back and check all Russell bull markets back to 1980, The average advance is almost 120%. The median advance is about 102%. The maximum advance is 314%.
Wow.
So the Russell 2000 is broken out. That's a plus. That's a plus. And then I got lucky again because I sent something out early this year entitled Physique and Market Symmetry, which I used Steve Reeves. If you'll remember, he was a Hollywood star in the Sword and Sandal movies of the 1950s, but he was known for his tremendous physique, market symmetry. And I looked at the S&P relative to the Russell going back to 1978. Please remember, there are not many cycles because they're so long in length, and the S&P outperformed the Russell over 3 cycles by 88%, 84%, and into the summer of 2025 by 83%. So I thought that that was some sort of market symmetry, that the S&P has done had done the same thing in prior cycles with respect to percentage advance versus the Russell as it did in this particular cycle. And then I extended that physique metaphor into my most recent chart packet, which was entitled for my most recent webinar, The Giant Killer. And then I used a bodybuilder from the 70s by the name of Danny Padilla, who was a giant killer. He was only 5'2", and he ended up beating much bigger competitors. And I extended that to the Russell 2000 as being the giant killer. So I think the Russell 2000 could get to 3,200. And then you mentioned the XLE, and then I'll stop talking here. The XLE is close to breaking above what has been Dikembe Mutombo resistance, at least as far back as 2022. So I think that it's going to break out. There's a lot of good internal action in the energy sector. And as you said, I believe correctly, it's doing so without the benefit of oil. Now, oil got down to $55 4 times in 2025. My target was 52 that I established in 2024. It got down to $55 4 times, and maybe I'm wrong, but in my mind, quadruple bottoms don't exist. However, I thought that was the wrong statement. I think the right statement is oil should have broken down. Why hasn't it? And if it hasn't broken down, then I want to keep an open mind as to it potentially rallying. But I wonder if, as you said, and I think correctly, the XLE is, giving us information about oil's potential, improvement, and foregoing its potential breakdown.
John, last thing, just to elaborate a little bit further. XLE is just one representative item, which doesn't have as much torque as some other ones. But the redheaded stepchild, OIH, which tends to be, I think, a higher beta piece of merchandise, the carrying the coal mine, if you will. What does the OIH look like to you?
I think the OIH is also good, and this has and certainly is not, it has not been and is not as good as the XLE, but this is also ascendant. And then I'll mention another subcomponent of the energy group, which I don't think gets any attention at all, are the coal stocks. And the coal stocks have acted very well. And I tend to avoid natural gas because I have a self-imposed moratorium. I never talk about sex, death, or natural gas because I can't get any of those things right. But
John, answer that. Maybe up until recently, dollar yen, the same thing, or JGBs. And
yeah.
go on, yeah.
Anyway, but I think the energy sector is really in good shape here. My internal work for this sector is strong, and it helps the non-growth do better than growth. And I think it's part of the natural resource, demand for natural resource related stocks.
John, you're ace. Really appreciate you hanging with us. If you can for a little longer, it's great. Just hang around. But if not, class dismissed. You're very generous with your time, folks. That's just. It's what a privilege. John, always wonderful. You and I will talk offline. There's other stuff to talk about. But
Thanks, George.
keep up the good work, my friend.
Thank you for your help. Very kind of you. Thank you.
Thank you. All right. We'll now turn to Lax. Are you there, Lax?
Yes, George, I'm here.
Good morning.
Good morning.
Good morning. How are you?
Good, good. It's a snowy day.
Yeah, you're going to get really belted with snow where you are. No, I mean, I think going to. I mean, you're only 45 minutes from me, but I think you're supposed to get particularly hard hit. No,
Yeah, it's close to a foot.
right?
Yeah,
Wow.
yeah. Well,
All right.
we're
Well,
all snowed in.
yeah. So why not? We thank God for Twitter. We can talk. We can have this space. So, all right. So, always good to hear from you. A lot going on. What's sort of been catching your attention of late? I know I've got some questions. If you want to weigh in on what do you see going on in the world of AI and the credit nonsense there, and CDS on Oracle and all this stuff, or whatever else is interesting for you. So, floor is yours. Whatever you'd like to talk about.
Well, first, thank you. And secondly, I wanted to talk about early on when you started the conversation about valuation and everything is and that made me to think of there's a new term that's going around called vibe investing. So people invest because they think it's cool or they don't want it to, it's the fear of missing out. And that's what I wanted to add in. This vibe investing is just retail investors are doing it and some institutions are doing it. I think it's distorting the entire market. Uh,
Vibe investing because it's cool. Okay, got it. Yeah, okay, sure.
yeah.
Got it. Yeah, okay, man.
And
Keep going, keep going.
there is also I found out a new term last week. It's called vibe session. It's not recession or depression. It's vibe session. That is a disconnect, the ongoing disconnect between reality and what the data is telling us. So that is a dangerous precedent for from our point of view because that distorts the reality, and that's where our concern is. And the other thing we were in, since you wanted to focus on a specific stock, so the areas that people wanted to short. First, I wanted to talk about the the 2026. We think the best shot opportunities overall is in the consumer and credit sensitive sectors. Some are available in commercial real estate, especially with hyper regional banks. We are still focused on the auto dealerships and OEMs. We see a lot of short opportunities and private credited funds that are publicly traded. High opportunities in travel and hospitality sectors and lenders with asset backed securities and asset backed lending exposures. So, restaurants and consumer centric businesses are critical, and there are a lot of opportunities for shorting there. What I wanted to share about is the credit side. And yesterday I was speaking with someone, Macro Edge, and they asked us about our work in asset-backed securities. And there was a guy who focused on credit, and he asked me why we think it's critical for equity side and the credit side to be integrated. And that's the work we have been doing. um, we think that the equity side, and we know that the equity side is not telling the real story of what's happening, whether the lenders the loans are performing well, whether you have enough provisions for credit losses to back up any losses that's might or might not come out. So equity market, and I think your John, I believe, when he said the equity bulls are running on hope, commodity bulls are running on fear. And I think the credit side is the one that tells the reality of the market. And that's where, at least from our point of view, the least focus from the equity side. And that's where our focus has been on the asset backed securities market, especially after the Tricolor and First Brands incident. We are very, very focused on the asset backed securities. And we get the pulse from the data analysis and we do a liquidity overlay to see when it will impact the equity side. And that kind of gives us an overview of a particular stock that we are recommending. And it also helps us to a certain extent to avoid any blind sides for our recommendations.
So okay, that's terrific, awesome. Sounds like that's a method to your madness. So I don't know, maybe just speak about one or two ideas. Things that people should be looking at right now. So for instance, all right, so I'll trigger you. So and in fact, I got a DM from someone just now. Ask her about Carvana. Ask her about Carvana. So few people watch Carvana as much as you do. So, and I know you'd highlighted a little while back some of the things were deteriorating, blah blah blah. But I don't know. Is it time to short Carvana? What do you think?
Um, to be completely candid, we have been recommending people, investors, retail, and institutions alike to stay away from Carvana. And I am sure that this is not a popular opinion coming from a short seller. And there is important reasons for it because we stay away from cult stocks. That includes Tesla, Carvana. No matter, yes, it's a fraud. It's an alleged fraud. Yes, we saw pages and pages of short sellers report on it. But at the end of the day, the stock keeps going up, right? And no one, I mean, at least we are not smart enough to call a top or a bottom on any stock. What we do is a primary research. What we do is fundamental analysis and research on the credit side. Having said that, I'm not going to say when it's time to shut Carvana because that goes against our um, golden rule to stay away from cult stocks. What I can say is that on our newsletter, contrarianunicus.substack.com, we are focusing on asset backed securities for Carvana. And what it has been is they are deteriorating at a faster level, not only the vintages, but also on the prime cases. So FICO scores above 705 or 710, they are having delinquencies, they are seeing delinquencies going up. And it's not only on one specific vintage trust, it's from all the trust, and every month you see them initially for example in 2022, right, they initially you see everything is fine, then you we started to see the modifications of a certain loans started to spike, then the modifications started to flatten out,
Right.
and then you have the delinquencies for 60 days going up, and we are seeing challenges for Carvana on the ABS side. Does it mean that it's a ripe time to short it? Probably not, because ABS is non-recourse.
Got
That's
it.
a yeah,
Okay. All right.
yeah.
Okay. So that's clear. So sounds like you wouldn't own it, but it's not necessarily time to short it. So let's talk about something. Let's try to help folks in the room. What is actionable right now? What do you think is a good buy or a good sell? Like, just pick one idea for people. Like, you mentioned a lot of areas of potential shorts, whatever. If you could pick like one idea that people could look at, that would be helpful. Is there one stock you'd like to mention which is interesting as a buyer or sell?
Shorting is something. Stellantis, I would pick. Right, Stellantis and CarMax, I would pick as a short, and that I can share publicly. CarMax, because it's been taking, from our sources, we know it's been taking market share away from Carvana. And we've been recommending that as a short since north of 100. And Stellantis, we've been recommending as a short from north of 20. That's because they have we expect a huge write offs coming on the EV side. And Stellantis management can't run a business. Even if you put like a flow chart on on their whiteboard, they just don't seem to know how to run a business. So Stellantis and CarMax would be our our top short picks if you ask that I can publicly share.
That's great. That's great. And what's going on in the power and the AI world? I mean, can you speak to, like, I don't know how much you're paying attention, like, you had people starting to get very suspicious about Oracle and the CDS for blowing out and blah 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 blah. So, can you speak on Oracle or any of those related companies?
Oracle is something we don't follow, but what I can speak on is with respect to data centers. I don't know if that's
Okay.
something
Yep.
interests
Yep.
you.
Yep. Yep.
So we have been on the sidelines and observing AI and the data centers. And recently, we started recommending one of the data centers to our clients after months of having boots on the ground in Virginia, which is a cluster of data centers are there. And our investigators went there, spoke to the people living in and around the data center area. There are a couple of things worth noting is that no one knows whether there is an oversupply of data centers corresponding to demand. And we suspect there is, and we are trying to find that out. Secondly, the rising electricity cost in and around to the consumers is high. For example, in Virginia, in a specific county that I think Loudoun County, we went and checked, and the electricity prices were north of 25%, and it's being passed on to the consumers. Um, I think they waived the property tax because the data centers are mandatorily paying X amount of money to the county they are in every year. That doesn't mean they will absorb the electricity cost. It means that they just waive the property tax. That does no good to the consumers. So the data center story, especially for the one we are recommending, is our focus is not one focus is the power infrastructure or lack thereof. There are also a lot of quiet cancellations of the project that we are hearing. Melody also corroborated that. We work with her as well on this. The quiet cancellation is a problem because it does not impact the stocks that are reliant on the data centers because you don't see the cancellations in the mainstream media. The cancellations are primarily driven by um, the the county or the state pushing back due to the excessive cost in electricity, due to the power grid not able to hold hold on to that kind of pressure from the data centers. So these are the reasons that needs to be the public need to be aware, the investors need to be aware, but they are not mainstream. They are quietly canceling it, and there are also a quiet surging of idle data centers in California, for instance. There are two of them. And the idle data centers is they started building up the data centers without getting authorizations from the power department, and they will be idle for 2 years until they can be turned on. So we have mobilized our team that we hired in these areas, and we will continue to keep our clients posted. And if we hear any new information, I will keep you
All
posted
right.
as well.
Yes. And then moving along. So there was news after the close on Friday about was a was a write down of was a BlackRock wrote down uh, one of their funds was I think 19% on net asset value. So this all gets into the private credit stuff and whatever. Have you been following that situation?
Yes, we were um we were following it. It's mostly BDCs, and there were also I just don't have it on the top of my mind, but yes, we have been following it, and I'm happy to post it under the space.
Okay.
I'm
Um,
trying to get the notes on that.
yeah. No. No
All
worries. No
right.
worries. No worries. All right. Great. Well, maybe some folks have some questions. I'm having a little technical issue here right now. I can't can't see if anyone wants to raise their hand. Is Unicus, can you tell me, has anyone got their hand raised if they want
Nope.
to?
Nope.
All right.
Yeah.
So I don't know if Ryan or O'Hare, Gnostic, any Bob Coleman, if you're around, maybe you can if you want to weigh in. Unicus, I'm having a little bit of a problem here with the space. I don't know what the heck is going on. I but the I can't see everybody. So you'll have to tell me. Oh, here we go. Hold on. All right, Star Punk. Oh, all right, Bob Coleman. Bob, we're gonna get you. Hold on, and Bob Coleman.
Yep.
Bob, can you hear me? Okay. Bob, you there?
Yeah, can you hear me okay?
Yeah, excellent. Great, great. Thanks for dropping in, Bob. That's fantastic.
Sure.
So Bob, you lit up the space a couple weeks ago. Be great to get your updated views. I mean, here we are. Just go with markets. Just I know you heard John earlier, and I think we're both big fans of John. Market trades bid. Some people are saying, "Gee, there must be someone caught short." Well, I look at it, and that may be true, but I look at it the other way. I think there are a lot of people. It's a bad joke here. A lot of people call it long fiat currency. That's the way I look at it. So, things are moving very quickly. What's top of mind for you right now?
Yeah, no, yeah, he put on or he put out a lot of great information earlier. Yeah, you know, I try to take this thing one step at a time. I'm not big on all the hype. There is so much misinformation that's being plagued on social media right now with the metals markets. Yeah, there's a lot of excitement. I totally understand that, but this idea that in October London was going to fail and the LBMA was going to break down and the COMEX was going to go bankrupt and the banks are 6 billion ounces short silver and no one's come up with any credible information or resources or links or references or anything. This is just a lot of innuendo and sort of happy talk, I think. And part of this problem is the retail dealer industry and the retail metals industry, which is completely unregulated, can come up and just pay people to say pretty much anything out there. Or you have retail dealers that are operating social media accounts behind the scenes that are, continuing, the hype obviously to sell metals, but in reality, on the retail side, there's a lot of talk that there's no metal available. The problem that we have is, certain products may be tight, but there are a lot of products that are very available and the bids are just completely collapsing. I mean, you look at some of these like junk coin or 39 fine, some of the 39 fine silver products, wholesalers are bidding, close to $4 under spot, $3 and $4 under spot. And some junk products like 90% US coin or 40% US coin aren't even being bought by wholesalers because they can't get rid of this stuff. The issue that we have with uh, junk silver, which is the pre 64 quarters, dimes, halves, that type of thing, is the refiners are so backed up with 395 metal, it just takes a lot more energy and time to melt down and refine the 90% plus nitric acid, which is a component that actually aids in the silver production or breaking down and separating of metals is in very short supply because the military industry has been buying the crap out of it. So you don't have refiners the ability to utilize that to help break down the junk silver. So that's causing a backup as well. And at this point, there's not very many wholesalers left buying this stuff because and the ones that are paying almost $10 under spot at the moment, which is something that I've been warning about. As prices go higher, the bids are just going to completely, the spreads are going to widen out. You have these big online retail dealers which promote themselves as the white knights of the industry, which are just raping and pillaging, in my opinion, consumers at this point. A lot of them are paying $9, $10 under spot and charging $7 over spot, or in some instances for silver eagles $14 over spot and paying $4 under spot. So you're looking at $16 spreads, for example, on a lot of these products, which most of the public, you don't have any disclosure when you're going in buying the stuff, knowing that, hey, listen, the price has to go up another $15 just to break even, which is the unfortunate thing. And that's part of the problem with an industry that's just unregulated. But yeah, from a pricing perspective, we get above 105 or so, we could see a shot to 120, kind of like what we were talking about a couple weeks ago. That's not out of the ballpark. I mean, you're in sort of a parabolic type of curve, and no one knows how high this thing can go. We've been through these bubbles, in 99, 2000, and we talked about, we discussed it last time where the Nasdaq doubled in December of '99, then doubled again from January to March. Silver looks like it's doing the exact same thing, where basically it had a big month in December, and now it's having another big year so far in 2026 that is culminating in more of a short squeeze. You may have producers. My guess is you have producers and miners that are probably caught short on their hedge book. It's very similar to what happened in 2011 and 1980, where the miners don't have an exceptionally big balance sheet from a standpoint of on the hedge side to continually maintain and meet margin calls on the short side of their book, basically shorting production that's in the ground that's waiting to come out of the ground. A lot of times they'll lock in profits and then when they deliver the metal, they close out the short and life goes on. Well, now the problem is, the price is going up so fast that they have to add more money to their
Right. Yeah.
short
Yeah.
book.
Yeah. Yeah. Bob, just stop right there so people can understand that. I know this is like you can do this in your sleep, but for the average person in the room to understand this, these miners, they don't think they're taking much risk because they're hedged. They're basically just selling forward the production that's going to come out of the ground. But just so people understand this, in the end, they'll be all right. But the problem is that the item that they're short gets bigger and bigger on their book, so they have to put up more collateral to maintain that. In many cases, they can't put up the money or don't want to put up the money, and that's why they're forced to cover. Is that correct?
Correct. Yeah. And then you have the COMEX. The problem that the COMEX has instituted now is they're basically the margin or performance bonds or margin rates are now a percentage, not a fixed price. So now they just automatically increase as the prices
Ah,
go up.
got it. Okay, yeah. So did they make that change recently on the Comex margins?
Yeah,
Is
it was
that
about three
yeah,
3 weeks ago they
right?
instituted percentages.
Got it.
Yeah,
Okay, so, you're right. Okay, so these guys when they're hedging, they don't think they're taking a risk, but the problem is unless they can keep adding more collateral to maintain the hedge, they're forced to close out eventually. Is if I understand you?
right, right. And the problem you're running into now is the COMEX trading volumes or open interest just started going up in I think on Friday, but before that they were just dead. You have managed money that's continually liquidating the long side. You don't have a lot of sellers per se. As managed money, which I think they're now below the December 2024 timeframe in terms of their long position. There's not a lot of longs to sell at this point, and so anyone who's short doesn't have a lot of people to buy from, and that sort of accentuates the short squeeze, so to speak. And that's part of the problem that I always envision what would happen in the silver market is as this price continues to rise and the carrying costs get bigger and less participation, so forth. The market goes more to the physical side of the market, in terms of price performance or price discovery. But now we have obviously a lot of momentum money coming in. I heard a very large money manager on Thursday was buying call options of 120, 140 strikes. The rumor basically is the same money manager that came in. I think it was in December, started buying, and then the price started taking off. Then, and this is a very very well known manager from what I hear. So, and he's been very long the silver market at times using derivatives or options.
So Bob, let me ask you this. Look, we're in uncharted territory. Nobody really knows, but you've been around. This is element of pattern recognition. So, a couple questions, open-ended questions, like how high? Forget about the next week or two. Nobody really knows, but say over the course of 2026, if you, and not to give a single point number, but give sort of, I don't know, just a range, min, max, probable. Like, how high do you think gold or silver could go? And then, secondly, what are the things you'd want to look for to determine that we're maybe kind of getting close to the top? I mean, I mentioned some, early on in my ramblings about what I would look for, responsible fiscal, monetary policy, et cetera, et cetera. But whether it's I don't know, wild participation in ETFs and buying by the public, or um, price just totally going totally to the moon or whatever. What would you look for you to start thinking about changing your tune? So two questions: A, how high do you think this could go? And then B, what would you look for to call a top?
Yeah, I mean, I guess going to a backdrop, there's a couple things. I just posted on my, and I sent it to your DM. You look at stocks versus gold and silver. This is a chart going back to August 15th, 1971. So the reason why I used that date was that was the date that Nixon went off the gold window. So this is a very long-term chart. It kind of gives you a snapshot. It obviously doesn't take into account dividend reinvestment or dividends being spun off on the S&P 500 and Dow Jones, but it gives you just simply pure price relative performance. So if you look at that chart, I don't know if you can put it in the nest, but um, there are times where silver actually outperforms gold. And then oddly enough, gold has actually, you know, outperformed silver, or sorry, outperformed the stock market quite a bit of the time, actually. And now you have, if you look at the performance at this point, gold has been by far the best price performer of even more than the S&P 500 or the Dow Jones, excluding, you know, dividends and all that kind of stuff. But and you also have to take into account that the S&P 500 and the Dow Jones are not the same index as they were, you know, 50 years ago, because there's so many companies that have come and gone since then. So they, you know, which is kind of a unique thing with the S&P and Dow Jones. So it's hard to even compare that. But if you look at it right now, the performance on gold is plus 10,000%. The S&P is, you know, nearing 7,400%. Dow Jones is about what, 5,200%, and silver right now is just coming up on 5,000%. Silver could play catch up and almost. There are times where silver actually has outperformed gold even, in terms of relative performance. So, you know, you could see a double basically on silver to try and catch up to gold, and maybe cross that like it did in 1980. That wouldn't be unexpected. Obviously, it's you know, we are talking about with silver very spiky. Price movements, you know, to try and grab the top is going to be nearly impossible. Liquidity, I would expect, be one of the signs of you know, the plate's starting to wobble, spreads starting to widen. You have to remember, and this is one of the things when I talked about silver 3 or 4 years ago, was that institutions cannot buy or have not bought physical silver. They go into the derivatives market. Most of these charters do not allow physical assets to be purchased. They have to be either funds or securities or derivatives, structured products, that type of thing. So my guess would be is you're going to start to see sort of the, you know, these ETFs go either to massive premiums because they either can't get the physical, or you start seeing breakdowns in spreads. I mean, we saw a little bit of this in October, but right now the spreads are normalizing per se between New York and London. A lot of people are saying, you know, that, you know, there's a shortage of metals and so forth, or China's not exporting metals. Well, no one knows what China's doing because we don't have any 2026 numbers yet. But from a standpoint of backwardation, we're not seeing that right now, with between silver, March silver, and London spot price. The only time we see backwardation is these big sell-offs, and that tends to give you sort of the look that, okay, the market still is in a tightness mode. But you know, as this thing progresses higher, I think you start to see, you should start to see more contango, or basically the futures market become more pricey uh, uh, compared to the London spot price. And the reason for that is, you know, the squeeze starts to force an acceleration of the move on the futures markets higher, because that's really where potentially the short position kind of lies, if that makes sense.
Great. And then before a couple more questions, I want to bring some other folks in. You know, shockingly, it really hasn't been the U.S. You know, domestic investor leading the hit parade on the metals. Um, Let's talk of the consistent buying from central banks, or I read a lot about what's going on in Asia, particularly the Japanese. I mean, there's been a lot. Read some good stuff from the folks at GavCal. Well, maybe I'll post something in the Substack on that. That Mrs. Watanabe, you know, the proverbial Japanese housewife, sitting there watching her yen, you know, the value of her money disappear. Not just because the yen's going down in value against other fiat, but also uh, yeah, you see inflation now having picked up in Japan sustainably for the first time in a long while. And there's been a lot of talk about buying from the Japanese. I mean, you mentioned the Chinese, I don't really know what they're doing, but I guess what I'm trying to get at, if one's looking at the US investor, um, as the driver or a primary driver and what's been going on, are we not possibly looking in the wrong place? And aren't some of these other influences, in fact, like really where one should be looking? Or put it another way, what is driving the price of these metals?
Well, Michael Howe, which obviously you turned me on to Michael Howe. He's
Sure,
incredible when it comes to
sure.
liquidity. And one of his thesis is basically China's driving this whole thing because China is obviously liquefying their markets and adding liquidity flow at a
Right.
time where they're trying to obviously get out of the real estate bust and so forth. And that could be definitely one of the drivers that basically is the wind to the back at the moment, not allowing sort of the prices to kind of stabilize. And of course, anybody coming into the U.S. market looking to try to short this thing is just getting absolutely ran over. And of course, volatility is rising as well because volatility happens to rise when prices on precious metals have been going up. That's one of the earmarks that's really happened the last couple of years. So then you have this gamma squeeze on the options market, which is just creating even more FOMO, and people are just throwing gobs of money into a sector that's very tiny. I mean, these are all, it's a momentum driven trade at this point. And that's part of the problem is you don't know where this thing could kind of peak out or consolidate or have a big pullback from. That's what makes this really difficult. You're right. We are in uncharted territory.
So, Bob, if this is, let's just back up for a second. Maybe you said this or wrote this. I can't remember who said what anymore, but I was reading something the other day. It's not something you said, it's something you would have said. You mentioned early on going off the gold standard with Nixon in 1971, blah, 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 blah. Um, Maybe this is just about the market, in a way, going off the dollar standard. I'm not saying getting we're getting the reserve currency. I'm not saying that. The dollar will always be the reserve currency. It still can be worth less. But just that the market's kind of like, you know what, we're not so cool with dollars anymore for the whole litany of reasons we've discussed many times in these spaces. And we're getting away from fiat or fiat generally. It's just a pick on the dollar. We want to get away from fiat, and the money's got to go somewhere else. And gold is just, one of the most obvious places where it would go. I remind folks in the space that the market. I was going right through these numbers the other day with somebody. I think it may have been Ryan actually. The value of all the gold in the ground. You'll know the numbers, Bob, but like the value of all the gold in the ground, something like 32 trillion. But the value of all equities, I think, is 120 trillion. The value of all the bonds out there is 300 trillion. So, and then before you get into real estate, let's just talk about financial assets. If you just look at stocks and bonds globally, you're talking over 400 trillion, and gold's only 32 trillion. So if people just say, hey, you know what, we want to somehow exit the fiat system and get into something which is a store of value, like that would explain it. And when I think of it that way, it's just again, I'm just hallucinating, trying to imagine like what could happen. But if folks try to get out of, exit the Titanic, and they all want to jump in this lifeboat, i.e., 450 trillion is trying to get into a lifeboat that only holds 32 trillion. You get the point. It could get really, really interesting. So, like, what part of that would you agree with, disagree with?
Well, no, I agree with it, but here's even a number that'll blow your mind even more. I mean, if you look at derivatives, I think the last number I saw, which was a couple of years ago, was 1.2 quadrillion. Where do you go if the problem is this is a counterparty and systemic risk issue ultimately. I mean, I'm not saying it's going to happen this year, but that's really what drives the physical metals world on the monetary side. It's the idea I don't want anyone else's promise to pay. And when everything hits the fan, just like we saw in 2008 when Lehman Brothers went down, from what I understood, there was not you couldn't buy a gold Krugerrand for 2 weeks after Lehman Brothers went down because everybody was like, who's next? That's the the metals move on fear ultimately. I mean, it's yes, there's greed and there's playing the options market and mining stocks and all that kind of stuff, but when you're talking about gold, it's a fear driven asset. It's always been that case. Fear is a much more powerful emotion than greed.
Right.
So that's what we're seeing right here. And the issues that we have, not to be political, because I try to stay out of politics, but the world looks at what Trump is doing. The world looks at what China's doing.
Sure.
They see this board game of risk that's kind of playing out. And the question is, a lot of these continents or countries are saying, well, am I going to be the one that's going to be kind of left holding the bag? When these other countries are just getting bigger and stronger, and kind of taking more countries for themselves, and more resources for themselves, that makes them want to pull back from owning those types of assets of those countries, and that's partly what we're seeing here. I mean, was it Denmark or I forget which European country on Friday talked about pulling their
Yep.
pension assets out of U.S. dollar denominated
Yep.
assets.
No, you're 100%, 100%. All right, that's great. So, Bob, hang there. I'm sure I have some more questions. I could talk to you all day, but I want to work some others in.